Welcome back guys to QBSYLUHV channel. Today will be educational video about how to find and how to trade support and resistance levels. Support and resistance levels, it doesn't look like some specific line on the price chart. It looks more like zones. This place always attracts traders because near the levels there are obvious places for setting stop losses and entering the trade. Also, there are always limit orders of large buyers or sellers near the levels. Let's take a look on this chart and try and figure out what are levels. Support level is in the area on the chart with a potential strength of buyers, the moment when the buyers entered the market. The resistance levels in the area on the chart with a potential strength of sellers, the moment when the sellers entered the market with a large volume, which allowed them to take advantage of the buyers and stop the price increase. It's easy to understand when you mark some zone and the price breaking out the resistance levels. Now resistance become support, and the same in opposite way. If the price tests a certain area several times, making a small pullback, most likely this level will be broken. Focus on the K levels that are immediately visible. Don't draw too many levels on the chart. Try to keep only the main ones and discard the secondary ones. If you find yourself wasting too much energy looking for levels, you're probably drawing more levels than you really need. In the books on technical analysis and on the internet, you can often read that the more often the price tests the levels, the stronger it is. But it is a gross mistake. In fact, the more the price touches the level, the weaker it becomes. Imagine that we have a support level. The price bounced from this level because there are buyers in the market. If the price often returns to the level, that means that the buyers' orders are gradually being executed. And when they are fully executed, then who will buy it? Otherwise, you may encounter two problems in your trading. The price does not reach the level and the price go beyond it. When the market gets close enough to the level without hitting it, you may miss the trade because you are expecting a trading setup to appear exactly at the level you choose. In a situation where the price goes beyond the level, you think that the level has been broken out and you try to trade the breakout. But this often turns out to the false breakout. So how to solve these two problems? It's really very simple. Always treat support and resistance as zones on your chart, not exact lines. How to find out what will break the level? As we already know, support is in an area with potential buying pressure. Therefore, when the price approaches the support level, it should turn into the opposite trend. But what if this does not happen and the price starts consolidating in the support level? This is a sign of weakness, as the bulls are unable to forcefully push the price up, or there is strong selling pressure in the market. In any case, this situation doesn't look optimistic for the bulls and the support will probably not be able to resist. Let's take a look on a real example on the chart. Usually to take a look and define out the best area and the zone support and the resistance levels, I go into line and cut all noises. So for example, we can mark this level like resistance and this is like support zone. So like you can see, we got some fake out. This one, and on the candles, we got huge weak candle, some fake out, support, don't touch support zone, and fake out. Then we can make next one. We can count the percentage of this, our zone is 24%. So the middle line of this zone will be 12. Then we go to horizontal line and mark it our 50% of this sideways move and this zone. So now in this trading zone, we can try and find out the good enter or exit point. So in this case, if you trade on a 4-hour time frame, you know this was one touch, second touch, third touch, and we bounce it and find the rejection. This one, touch, and going down, and find support once again here. Try and open long position. So you can add this here and your stop loss will be lower than this line low. On the candles, this low, it's much lower, but we want to minimize our losses. That's why if we use the candles, our loss will be around 5%. But if we use the lines, our stop loss can be around 2% and 50. That's why maybe we have all chances. So we break these levels and going down. That's why we make a smaller losses. And we're going up to the next resistance zone, to the top. So we can see our profit can be around 23% on the spot. With the leverages, it will be much, much higher. We bounce it, make a fake out, and in this area, you can close your position. Try and open short position from this breaking out. Stop loss can be, in this case, yes, it will be the 5%. Now it's a support zone, and if we go in right, we're breaking out this support zone, and now this zone flip to resistance zone. So now if we're not hold this line, we can break it out and go into lower support area. And after this, we can go in sideways once again, but with a lower price. That's why how you can trade and how you can find the support zones, not the specific price. For example, this current situation can play like this one. We can go into the middle line, trade it here, and breaking out, forming the higher high, retest once again this zone, and on this breaking out, you can open one more long position, and stop loss can be lower than the middle line, or even here if you want to minimize your losses. And in this case, you have to look on the next resistance and support zone on the higher time frames. Guys, I hope you liked this video. Share this content with your friends and hit the like button, hit the bell notification button. Don't forget, join my Telegram channel where I can share all my ideas faster than on YouTube. See you next time, guys.